Hi, I'm Dana Samuelson, president of American Gold Exchange in Austin, Texas. This is a special report on inflation's disruptive power. We're going to do this in two parts. Part one will be inflation then and now. Part two will be inflation's cost and effect. Before I start my presentation, I've been reading two books. The first book is 3 Days at Camp David, when Richard Nixon pulled closest advisors into a 3-day meeting that broke the dollar's peg to gold in 1971, and the dollar was devalued 10% overnight. The first 30 pages of this book, though, talk about the post-World War II Bretton Woods Agreement and the establishment of the dollar as the world's reserve currency backed by gold. And it's one of the best explanations I've seen that the layman can easily understand how the whole system was created and how it was supposed to work. And the book explains why it had to be broken. The second book I'm reading is Paul Volcker, Keeping at It. He was the Federal Reserve chairman who tamed inflation in 1980 and 1981 through aggressive federal funds rate hikes. And this is the book of his professional history. It's very informative. So I highly recommend both of those books. They're both very apropos in today's world. So let me share my screen. And begin my presentation. So we're American Gold Exchange. We're in Austin, Texas. This is how you reach us. We'd love to help you in the physical precious metal sector if we can. This is what our website looks like. It's got live, transparent pricing, and it's very information rich. But let's get on with the presentation. Inflation's disruptive power. Inflation then and now. This is part one. So what does inflation do? It creates a loss of purchasing power. And this shows the dollar's loss of purchasing power since 1870. The dollar basically bought more than $1 worth of goods until about 1920. During the Roaring 20s, it dipped a little bit, and it came back up to par again in 1933. But that's when President Roosevelt took us off the gold standard and took the gold out of the monetary system that you and I could use. And paper money was backed by gold, but that's what we used, paper money. US citizens were no longer allowed to own gold. The dollar's skid began in earnest then. You can see there's Nixon closing the gold window in 1971. And we've skidded all the way down today, where the dollar buys about 4 cents worth of goods and services compared to what it bought in 1933, about 90 years ago. And this is what inflation does. It erodes the purchasing power that we all enjoy with our currency. So here is inflation today. This is an inflation chart going back to 2000. And you can see inflation has barely been over the Fed's 2% target rate since the great financial crisis until this past 2 years, when inflation took off like a rocket, up to 9.1% as of last month's inflation print. This is the strongest inflation we've seen in 40 years. Here's a chart going back to 1955, which puts inflation today into perspective relative to where we were the last time we had one of these hot inflationary cycles in the 70s and early 80s. You can see those 3 waves of inflation beginning in 1965, going all the way to 1981. Each successive wave was bigger than the previous. And while it appeared that inflation might have been tamed, it wasn't. And that's the biggest point that I can make to you in this presentation. It wasn't contained in the first wave, and it wasn't contained in the second wave. It was only until the third big wave hit that inflation was finally contained by Paul Volcker, primarily because he had the desire to do it. And it wasn't about politics. It was about doing the right thing. President Nixon was worried about being reelected in 1972. That's one of the reasons inflation wasn't tamed during that first wave. He understood that if people were losing their jobs, they weren't going to vote for the incumbent. So this is the difference between political will and true monetary will. Paul Volcker had true monetary will. So let's look at the differences between 1970s and today. Between 1965 and 1970, we had LBJ's Great Society and the Vietnam War, which resulted in extra spending in the US, deficit spending. In 1971, President Nixon decoupled the US dollar from gold and immediately devalued the dollar 10%. That's what this book is about. In 1973, we had an oil shock. In 1974, Nixon resigned and we had a crisis of confidence in the US. In 1979, we had another oil shock and another crisis of confidence with our hostages in Iran. And this is during the time when inflation raged at its hottest point, 1979 to 1981. The 1980s and 1990s, well, everything was a lot tamer relative to the 70s. Might as well have slept through it. But beginning in the 21st century, we've had a series of events that have culminated in the inflationary cycle we're going through now. 2001, we were attacked and our deficit spending increased materially for the first time since the 1980s. 2008, we had the financial crisis and deficit spending surged. 2020, we had the pandemic, and deficit spending exploded. 2021, the global supply chain was broken by COVID, and that's material. Most of the, not most, but a good part of the inflationary problems we're having today is because the supply chain has been broken. There just have not been enough goods to fulfill the demand. And we've paid people not to work and given them extra money to spend. So there's been a demand surge while the supply chain has been broken. And this is what has allowed the inflation genie to get out of the bottle. In 2022, you're all aware that Russia invaded Ukraine. Well, this magnified the problems we've been experiencing, particularly with energy and food. The oil price has taken off from under $75 a barrel all the way to about 125. Right now it's about 95, but oil's up 50 to 70% from where it was the previous 5 years, which is the major driver of inflation in the 70s, 2 oil shocks. And now we've got Russia threatening Germany's gas supplies through the Nord Stream 2 pipeline shutdown. So Europe is especially vulnerable today because of energy shocks, and the whole world is potentially vulnerable to food shocks right now. Russia produces fertilizer, the #1 exporter of fertilizer. The Ukraine is the #3 exporter of wheat and corn, and that is not getting out of the country. Now, there was an agreement yesterday where they were going to be allowed to export the stockpiles that have piled up and have not come out of the country for the last 6 months or longer, but that may be already in jeopardy. So we're going to have energy issues and we're going to have food issues that persist for a while. How long? It's anybody's guess. The biggest difference between then and now is our debt has just exploded. In 1996, our debt was $5 trillion. And in the last 26 years, that has increased 6 times to over $30 trillion today. And you can see the 3 phases where our deficit spending increased, then it surged, and then it exploded. And this is a recipe for major financial problems for the US that we'll talk about in part 2. Now let's look at inflation in the 70s from about 1967 all the way to 1995, actually. This is a chart of the federal funds rate in blue and the consumer price index in red from 1967 to 1994. As you can see, the federal funds rate and the inflation rate tracked each other pretty consistently with a delay in inflation during those first two waves in the late 60s and then again in the early 70s. Then when inflation took off, the Fed funds rate followed. Paul Volcker inherited the chairmanship of the Federal Reserve in August of 1979, when the Fed funds rate was 7.5%. In the next 6 months, he raised the Fed funds rate to 17, almost 18%. He thought that killed inflation, and he dropped the rate back down to about 9%. But it didn't do the job. Inflation persisted and stayed high. So he was forced to raise the rates again to 19% twice in 1981 and 1982. The important point here, again, is this was 3 waves over 15 years of inflationary pressure, with each successive wave being bigger than the last. And it wasn't until the federal funds rate got over the inflation rate and stayed over the inflation rate materially, until inflation was tamed and stayed tamed, as you can see by the red line post 1981 and the blue line post 1981. So that was the resolve of Chairman Volcker to tame inflation. Now, he remained federal chairman until 1987, when Alan Greenspan took over. So that's what it took to tame inflation in the last cycle, getting the Fed funds rate substantially over and consistently over the inflation rate for an extended period of time. Now let's look at where we are today. This is the same data from 1995 to last month. You can see how tame both the Fed funds rate and the inflation rate has been over the last 20 years until now. And actually, this is last month's data. The inflation rate today is 9.1%. The Fed funds rate is still 2%, although I'm taping this on Saturday, July 23rd. The Fed's going to meet next Tuesday and Wednesday, and they're probably going to raise the rate to 2.75%. But they're still going to be woefully under the inflation rate by a large amount. Now, we do expect inflation to mitigate a bit over the coming months because the economy is slowing down. The US economy is showing a lot of signs that it's weakening, and so is the European economy. So we do expect to see inflation to mitigate some, but that doesn't mean it's going to go back to 2%. It may only fall back to 5 or 6%. And the Fed is probably going to continue to be behind the curve, and perhaps enough so that this may just be the first wave of inflation that we're seeing. If they don't get ahead of the curve and do it in this first cycle, there could be further cycles. We'll talk about that in a minute. But this is a very, very strategic point in time. And we'll see whether inflation is tamed in the short run or whether we might be prone to it for a longer term, which I fear may be the case. So here's why inflation is hurting everyone today more than before. It's because utilities, gasoline, and grocery prices have been rising at double-digit levels all spring, and it's probably going to get worse. This is a Bloomberg headline going back about 3 weeks. And here's a chart from that same story. In black is electricity and utilities. In gray is gasoline and other fuels. And in yellow, food at home. The last time all three were going up at 10% or more at the same time was 1980. And we're back into that same phase now, where all three have been rising at the same double-digit rate. We've had periods of time over the intervening years where one or two rose at that much, at that rate, but not all three at the same time. And this is why it's hitting everyone in their pocketbooks today. Now, this is a quote from Lynn Alden and her Lynn Alden investment strategy from her letter of July 10th, 2022. Lynn is one of the best analysts I've discovered in the last 2 years. She puts out a monthly letter to her subscribers, and I became one as soon as I realized how good she was. And the reason I like her letter is because she writes in terms that you and I can understand easily. This is what she said about inflation during the last cycle. People were miserable during inflationary spikes in the 70s because wages were slower and stickier to move up than price levels, so they could buy less stuff with their wages. That's also why economic activity was worse than the unemployment numbers alone suggested. And that's one of the things that the Fed is stressing today, that unemployment is low. And the economy is actually fairly good, but it's rolling over pretty hard. But I digress. Even unemployed people were getting a trim in their ability to buy real goods and services, especially necessary ones like rent, energy, and nutrient-dense foods. That's happening again now. I'm going to make 3 recommendations to you. One is Lynn Alden. That's her web address, lynnalden.com. I highly encourage you to subscribe to her newsletter. It's a great value for the money. The second newsletter I highly recommend is the Aiden Forecast, put out by my friends, Pamela and Mary Ann Aiden, who happen to live in Costa Rica. Their new newsletter, the Aiden Forecast, covers currencies, commodities, equities, and bonds. They don't have any bias. They're just simply reporting what they see. They've been doing it since the late 70s. I met them when I worked for Jim Blanchard in the early 80s. And their newsletter covering those issues. And that primarily, this is the strength of their newsletter, is they have proprietary formulas that they use to follow strength and weakness in markets, and long-term averages that they've discovered are highly effective in discovering when markets are reaching peaks and valleys. And for the bang for the buck you get on a monthly basis from the Aiden Forecast is really, really high. So I recommend both of these subscriptions, and also the New Orleans Investment Conference, which my mentor, Jim Blanchard, created in 1971 as a direct result of Nixon taking us off the dollar standard. He understood that the monetary system would weaken, or the dollar would weaken. So he created the New Orleans Investment Conference then. Jimmy passed away in 1999, but my friend and colleague from my old Blanchard days, Brian London, has taken the conference over. And that's where I discovered the Aidens back in the 1980s with Jim and Lynn Alden a couple of years ago at Brian London's New Orleans Investment Conference. It's going to happen in October of this year. It's a great 4-day event, and I highly recommend it. In fact, 2 years ago, at the end of the 2020 conference, Brian asked his experts, what do you think will be the hottest topic for 2021? And one of the analysts, Grant Williams, said inflation. And this was before inflation was on anybody's radar screen, well before. So there's a lot of cutting edge information at the New Orleans Investment Conference. Now for fun, this is a picture of me from last month with Danielle DiMartino Booth, who was a former advisor to Dallas Fed President Richard Fisher. Here I am at the Real Estate Guys Summit on Sand in Belize in June, giving Danielle some silver quarters for her kids. She has 4 children in their teens. Now, a silver quarter back in 1964 would buy you a gallon of gas. A non-silver quarter, when they took the silver out of the money in 1965, would buy you that same gallon of gas. Today, the non-silver quarter won't even get you a tenth of a tank of gas, where that 1964 quarter made of silver still will. So I gave her those quarters as an educational tool. And I also quipped that, well, if they don't want to buy a gallon of gas, they can also get a latte at Starbucks, which is what made Danielle laugh. But the reason I bring this up is Danielle's mentor is Dr. Lacy Hunt, who is one of the foremost economists in the US today. And he's been studying the economies of the world going back 100 years. He's a former advisor to the Dallas Fed as well. And this is what Dr. Hunt had to say about the Fed and inflation at the Malden Investment Conference in May of this year. The Fed unsuccessfully tried to contain inflation in 1974, but inflation, which mitigated for a while, continued to gain momentum into 1981. If the Fed does not control inflation, then the stability of the US economy in the longer term is seriously in doubt. If they don't take the long-term strategic view, our problems will only grow. And that's what Paul Volcker did in 1979. Consequences be damned. He took the longer-term strategic view. The longer-term risks to a prolonged period of economic stagnation and rising inflation would be the outcome. If some excuse comes along, or if they fail to contain inflation, we could expect a repeat of the long stretch from the mid-60s to the early 1980s. And what he means by that is if there's political pressure because inflation starts to mitigate and the economy slows down to the degree where the Fed is reluctant to continue to raise rates. I mean, they can pause, but if they start to ease either rates or quit quantitative tightening and start to go back into QE, this could be an explosive recipe for renewed inflation going forward. That's what Dr. Hunt means. And again, this is a chart going back to the 70s showing those three waves and how aggressive Paul Volcker had to be to contain inflation. Remember, the Fed and the ECB are raising rates today into weakening economies. And at some point in time, the pressure may grow where they may be forced to reverse track. And if they do, our problems may be magnified going forward. That's the point of part one. So let me unshare my screen. And thank you for watching. We're going to continue again in part two in just a moment. Thank you.